Hello, everyone. My name is Price Earnest Ratio. I'm going to share my screen here. I'm probably already sharing it. And today I'm going to talk about stock market tips and some tricks that I do when investing in the stock market. So one of the tricks I do is I buy on I like down days to look for stocks to buy. So at my stage where I'm in my career, I like to buy options and long-term options called leap options. And let's see what leap options stands for. So you can get a um idea of what they call what is leap options. Okay. So here you go. So long term. Here's the term, right? But our they're long-term options. So leap options are long-term equity anticipation securities or option contracts with expiration dates extending beyond 1 year, allowing investors to capitalize on long-term price movements in underlying assets. Let's read some more. Leaps are essentially option contracts that have expiration periods ranging from 1 to 3 years. They function similarly to standard options, but provide a longer time frame for investors to benefit from price changes. Okay. Now I won't go too much into the options period, but that's what I do. I like to. So today was a down day, and my account is a little down as we can see, and that might scare some people. But I said, don't be afraid. Don't be afraid. So another way we can one way I like it's a down day is when you see the S&P 500 down. So they base the entire so they look for market sentiment, stock market sentiment based on how well the S&P 500 is doing. So the S&P 5 they base that 8% annual percent return that you hear about. This is the they're talking about the S&P 500. This is an exchange traded fund. So 1 year ago from today, the S&P 500 grew by 14.8%, 87%. Some people may say that's not a lot of money. That's damn good. A lot of see Here's the stock market tip. This is one tip. A lot of investors lose money because they're looking for these tremendous returns, these huge gains. I do it too, but I don't put a lot of money in risky stocks. When it's risky, I put a little bit of money that way so I can stay in the game. But an index like this is pretty healthy. And if you would have bought this stock, let's say you would have put in $10,000 last year, let's say last year around when it was down, let's say this is in a year, so let's say you would have bought it at 579 October 25th of last year. Okay, to this year you'll be up by 667%. So you can do the return on that. This index has been going up every single year. Let's look at this graph. So here's a trick that I like to use. So you read graphs from left to right. You typically want to see your graphs like this. You see how this graph's going trailing up like this? It may have these are pullbacks. It might have a pullback right here, but it's steady going up. That's what I like to see. Now here's a bad graph. Let's check out a bad graph. Um, let's see. Is there any companies? Let's see. Let's check this one out. Um, so that was a SPY ETF. We're gonna come back there. Let's see if we can find any bad graphs. Now I don't like to see this. Look at this is a bad graph to me because look at this. It's not. It went up and then it's going back down and then it's these are higher highs. It got higher and somewhere right here it stopped and then it started. This is a downtrend. So this is an uptrend. This is what they call uptrend. It's going because it's got higher highs. It's going up and then it goes low. Learn you don't have to be a chart if you're a beginner. Don't rely too much on charts. You want to be a long term investor, and I'm gonna tell you right after this. I'm gonna give you a ETF right, in a few minutes. I'm gonna give you an ETF that you can probably buy exchange traded fund and exchange traded funds They automatically diversify you. I'm going to show you why. Just stay right here and listen to me. Okay, so this is down. This sucks. Look at this chart right here. It's going down. Here it was $20 a share. It went all the way up to 80 something dollars, $70. Now it's down. It's back to like 35. No, I like my charts going up, steady going up. And let's check the PE ratio here. See, it's got a good price earnings ratio. I don't know why it's going. Oh, but it's offering a 4%. Okay, now that change. Well, that changes everything, right? You get a 4.45% return on your money. So if you invested $10,000 in this stock, whatever 5% is of that, essentially you'll just say 10,000 times well, I got a nice calculator here. See my calculator? So you'll say 10,000 times was 5%. So you move two decimal places to the left, not right, the left, or you can just divide by 100. You can say 5 divided by 100. So let's see what that yields us. Okay, let's see what it yields us. So 10,000. It's been a long time. 10,000. All right, times 0.05. Okay, so that's $500. It don't seem like what that's $500 you didn't have before. And let's say let's just go up. Let's go up a notch. If you invested 100,000, that's that's 5,000 off 100,000. If you invested at 1 million, let's say you had $1 million. Let's say you had $2 million. You took $1 million and invested in this. That's $50,000 annually every year. So plus you still got the stock. So that's something to think about. But let's go back here. So here's a I didn't even see what industry this is in. Let's just see it's in the oil and gas industry. This is oil and gas and stuff like that. But let's go to the VTI. I think this is the Vanguard ETF. So my tip for today, again, this is my disclaimer. This is not stock market advice. This is education purposes. This is for educational purposes only. So let's go here. Let's see how this is a Vanguard ETF. It's up 15%. And same thing, about 14.6%. That's what you want to see. Usually when them stocks run up so fast, they have large pullbacks. This is slow growth. Over 5 years, how much it went up? 84%. So imagine you invested 5 years ago into this stock, and you put $100,000 into this stock. 84% of that, that's about $84,000 in 5 years. Look, these exchange traded funds automatically diversify you, so they're a little bit more safer. What do I do? Here's another tip. What do I do when I got safer stocks? I invest more because they're safer. Um, how do you become a big investor? You start as a small investor. So small investors. I'm still a small investor. So a small investor will take a little bit of money. I mean, they're looking for large gains. I understand that you got to take on a little bit more risk. But if you got $100,000 sitting around, you're not a small investor anymore. It's time to put that in the market. Don't put all of it. If that's all you got, take 50,000 of that because you got to have emergency fund. Again, your emergency fund. What is your emergency fund? You should have you should have whatever's left over after you pay your monthly expenses. That's your that's how you determine how much you should have each month. So I typically like to use the 3 to 6 month reference. Let's say you lose your job today. You want to have 3 months, at least 3 months of reserves, so you can get back to your next job. So let's say you make $10,000 every month. Let's say your bills are 6,000. Okay, all every month your bills are $6,000. So 10,000 divided by 6,000 is 4,000. So 4 times 4,000 a month times 3 months is 12,000. So you want to have 12,000 saved, and that's playing it tight. You probably want to do six months. So you got to have an emergency fund. Okay, so if you had 100,000, you could that's playing it safe. 50 that take 50,000 of it, put you can put it in an index fund like this. Now, let's see what's in it. So the fund seeks to track a market cap weighted portfolio that provides total market exposure to the U.S. equity space. This is a index tracked fund. Um, the Dow Jones it tracks the Dow Jones. It's a large bin. They got the number of holdings. It has 3,532 holdings. Okay, so what's in the fund? And this fund, these are the sectors. 33 point. Each of these are sectors: technology sector, consumer cyclical. That's a sector. Healthcare, consumer defensive, real estate, basic materials. All these are sectors, and each of these sectors have industries in it, like technology. One of the industries that's in here is semiconductors. Okay. Also, another industry inside technology is is electric vehicles. If I'm not mistaken, yeah, like Tesla. Tesla is in technology. So, what else they have here? Quantum computing, the new artificial intelligence rise. That's in the technology sector. What's in the healthcare? You might find Intuitive Surgical, ticker symbol ISRG. They make health equipment. So that's inside. That's an industry inside this sector. What else you find here? You got CVS. Like they sell pills, prescription pills, and stuff like that. So now let's go see what's really in this fund. The top 10 holdings of this fund. You got Nvidia, you got Microsoft, you got Apple, Amazon, and so on and so on. Let me mute this phone for a second. And so on and so on. So listen, I'm not the guy to tell you that you should trade every day. If you're looking for that guy, I'm not him. I'm sorry, because I don't want people losing money. I don't want you, you know, I don't want you losing money. We want to take calculated risk. Calculated risk is when you're very knowledgeable about the subject, and even with the stock market. Let me share my screen again. Even with the stock market, you're very knowledgeable about the stocks you buy. ETFs, you're sharing risk. All these companies are pretty much doing good. So you're not going to get a lot of price volatility, like large price movements, like you would a growth stock. But these are like value companies, and let's see what the difference is. Let's Google what the definition is for growth and value. So a growth stock. When you hear growth stock, that means that it's beating out its peers in in revenue. So it's growing. So its revenue might be the benchmark every year that people want to see is that any company is that your revenue or your sales is growing by 10% annually. Okay, not just the sales. They want to see that your total assets, your total net worth for the company is growing by 10%. Um, so they use 10% as a benchmark. So when you got a company that's where their revenue is growing by 15% every year, every single, not just one year, not just 2 years, but every year, then they consider that a growth stock. Okay, so value companies is just like value companies are. Let's see what the difference is. What is the difference? Um, difference between um growth stocks and value stocks. So here we got here. The difference between value stocks and growth stocks can be summarized as follows. Value stocks, so these are shares of companies that are currently trading below their intrinsic value, meaning that they got a low PE ratio. That's what they mean. Like low PE ratio. Another another term they like to use is it's got good book to market ratio, good book to sales ratio, and we'll go over that later. But let's keep going. Their intrinsic value uh, is trading below their intrinsic value, often considered undervalued by the market. They're considered cheap stocks because they have low PE ratios. Investors believe these stocks will provide superior returns as the market corrects their prices over time. So if the market has a when the market corrects itself, let's say it's having a pullback today, had a pullback yesterday, these stocks are going to do pretty good because they're they have been in the stock market for a long time, and they have proven that they can grow their earnings every year. Now, growth stocks, here this down here, these are shares of companies expected to grow at an above average rate compared to their industry or the overall market. Investors are attracted to these stocks for their potential to deliver better than average returns, often reinvest in profits to fuel further growth. When these are you're a new and upcoming company. You're not paying dividends on stocks. Some of them value stocks, a lot of them value stocks, they pay dividends. But when you and mostly the older people that's going into who wants to buy value stocks? Most of the people that's about to retire or older people in their older years, because I think stocks with good dividends are considered value stocks, blue chip stocks. So those are the people that they're 55 years old and maybe even 50 years old. These are the people that want to probably invest in value stocks because if the market has a correction, some people say crash, but it's just really a correction. They say that every time the market had a correction, them stocks have come back to do every them stocks have come back to do better in about 10 years. Not only have they have come back to they have regained their they have regained the 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 price of the stock, and then they went on to become better stocks. You know what I mean? And we can look at something. Just look at the pandemic right here. I could type in, let's type in this right here, the one we're looking at, SPY. So in 2020, there was a crash. I mean, there was a correction. Yeah, 2020. Where was it? I bet I know where it's at. It's probably like right here. See, 2020. So, um, so let's go here. So in 2018, this stock was $145. I mean, this exchange traded fund was $145. And then it corrected itself. It corrected itself March 2020. Everybody remember that. It was a big crash. 128. Who cares? But after that crash, look what it's doing. Look what it came to do. It came to seek revengeance. Okay, it went up to 233. Look at this graph. This is beautiful. I might put $100,000 in this thing. Then they're gonna go down here, 179. Whoop de doo. We told you it pulls back. September, this was a part of a bear market. But what did it do after that? What did it do after? Where's that now? It's at 328. Excuse me, I get excited about this stuff. So sometimes you don't have to look for all this high growth. Maybe you just want to get an exchange traded fund and call it a day. That way you don't have to look at charts all day. You don't have to be standing there looking at, oh, is that a head and shoulders? Oh, is that a double top? Um, well, what is it doing? It's like, I mean, the traders, the people that's trading that's impatient, who typically lose money, they just be looking at charts all day. Like, let me show you right here. Look, I can pull up a chart. You want to do this all day? Come on. Not saying I don't read charts because when I trade, I do trade sometimes, but in the end, I'm a long term investor. I don't want to be trading all the time. There's something called active investor and a passive investor. Let's type that up. What's the difference between? Come on. Just give me a little bit of time. I'm not gonna take too much of your time, but I want y'all to understand some stuff. There's people out there on the stuff on YouTube and stuff like that saying that telling you all new investors that don't even know much about the stock market to 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 just only invest in the stock market. Why would you want to do that? No, that's not diversification. You shouldn't have all your money tied to the stock market. For new investors, preferably, but you want to have like 8 to 10% of your money tied in the stock market. So if you're holding $100,000, put $10,000 in the stock market. That's pretty conservative. But if you want a little bit more risk, put 15% in there. If you got $100,000, put 15,000. If you got $5,000 sitting around, put 10% of that. 500. 15%. If you got 5,000, just put 1,000. What's that? About 20%. So here, so what's the difference between a passive investor, right? Passive investor um, versus an active investor. Know these terms. This term right here, this term right here is gonna it's gonna change your life. It's gonna change your life. Okay, look. So the differences between passive and active investing are as follows. Active investing involves frequent buying and selling of investments to outperform the stock market or the market. This strategy requires a hands-on approach, often managed by a fund manager who selects individual stocks or assets. Look down here. Passive investing focus on long-term growth by tracking market indexes, which we just showed you early, which I just showed you earlier, the VTI, the Vanguard index, that tracks that track as a market, that's a market tracker, it tracks the Dow Jones, one of the ETFs. This strategy typically involves less buying and selling, often resulting in lower costs and less complexity. So not only that, when you buy and sell, when you buy a stock and you don't hold it for more than a year, more than 12 months, you get taxed about 30%, 37% on that stock on your gains. Now, when compared to after holding your stock one year and then selling it later, you get taxed about 22%. That's a big difference. So let me show you how big of a difference that is. So say you made $10,000, right? 10,000. I can't show you the math for here. Just bear with me. If you, I probably put another thing in the chat. So let's say you made $10,000. Okay. Let me get a calculator, Google calculator. Let's see Google calculator. Calculator. Let's see online. Okay. Let's say you got $10,000, right? 10,000. Excuse me. Where's the delete? That's 100,000. So you got $10,000, and then you say and you don't hold your stocks for more than 1 year. Okay, that's a 37% tax. What's 37%? 37 divided by 100. So or you can do it like that, or just move 2 decimal places to the left. That's tens, hundreds. So that's gonna be 0.37. So times 0. Point. You don't even have to put zero. I just put there 37. 0.37. How much is that? Equals about what? Probably $3,700, right? Yeah, that's how much the government takes. That's how much the government takes. Okay, as opposed to 22%. That's gonna be $2,200. That's $1,500. You see what I'm saying? Now picture you made 100,000. Now they're gonna take 37,000 instead of 22,000. If you hold out the 1 year, it's $15,000. Should we go up a little more? I think you all see what I'm saying there. So here's a start. I use TradingView sometimes to look at to trade and stuff like that. I ain't set up my bar charts and stuff like that. But do you want to be the one looking at these little fine charts all day trying to figure out what the hell is going on with the market? Do you want to do that? Or you just want to be a passive investor, invest in a index fund and see and get your gains. So so okay, so that's right there. What else I got to tell you all? Anything else? Let's see here. I think we ain't covered most of what I wanted to talk about today. So this is again, this is about stock market tips and stock market tricks. Another trick I like I said, another trick I like to use is When they say buy the dip or buy on down days, sometimes you don't know uh, what they mean by that. Sometimes you don't want to buy because the stock might keep dropping. So what you'll look for is you come to barchart.com, and I'll do this over some at some other point in time. I go to barchart.com, I go to type in a company like Nvidia, and then I go to here on the left, technical analysis. I go to traders cheat sheet. Traders cheat sheet. What am I looking for here? Come on, we're gonna wrap this up. I'm looking for a relative strength index. Okay, I want to come here anyway to see what this is. So if you look down here, something called overbought, RSI, relative strength index. So they're saying here, 14-day relative strength index at 30%. So if stocks, it's at $160.09. So if stocks go back right down to here, like let's say it was a big sell-off, like somebody thought the market was going to crash. Typically, investors are these robots and these large head fund managers who buying and selling, who are trading and day trading. They might sell a lot of shares. And what is that? What happens when they sell a lot of? When you have more sellers than buyers, the stock goes down, or the whole stock market goes down. You know, and they get out of it, making the market oversold. So if they have more, and this is companies Nvidia. So if they have more sellers than buyers in Nvidia, the stock gonna go down. But sometimes the investor can get out too early and they can't get back in. Some of them probably got in at $100 a share. They can't get back in. Unless they have a stock option for that much, but we ain't talking about that right now. Just talking about buying shares outright. So this is $160.09. This is considered overbought, so this is where you want to buy it, closer to $160.09. Now let's go up in the red. Here it says 14-day relative strength index at 70%. I don't want to buy it here because majority of the time, more times than not, there's a pullback at 70% at $205.70. There's a pullback. I don't want to buy it here. So right now, Nvidia is trading at $180 right here, 180. So I typically want to buy close to the 50% moving average, the 14 at 50% RSI, and it's under that. So this might be a company that I may be looking to get back into. I had it before. I bought it in 2017. I ended up selling it too early, but I don't want to talk about that. So and also the last trick here is you could probably go to um, I'll talk about this later, but the SEC filings and go find their 10K reports. You know, the company has a report, its 10K report every year. So, um, what's this? Anyway, you can find transactions here. Let's pull this up, see what this is about. So, Nvidia Corp. It tells you where it's located and what it does. This is company filings. So, um, so name and address of seller. So this person, Jen, on he bought Nvidia, title of security sold, date of sale. He bought this July 21st, 2025. How many shares did he buy? He bought 75,000 shares. So usually when you see a person in the company buying that many shares, that means he thinks something good. That's a good sign because he's on the inside. Why would he buy all these shares if he thought the company was going to do bad? And this is the gross. He this is how much money he has in it right now. So this is what's this? I think this is 12,931,300. Here's another person. He bought. He just keeps buying. He bought on July 24th, 2025. He bought 75,000 shares again. It's just said, wow, that's how much his price is. I guess he just like to buy, come down to here. He's steadily investing. So Jen, this is the company. I think this is the owner of the company. Um, so I think this is the owner of the company. Okay. So here, it just says name a person whose account the securities are to be sold. So who is he? Relationship to issuer. Um, I'll find out who he is later, but I think Huang Jin Sung, relationship to issuer. I'm not sure what he does in this company. I thought he was the owner. Let me just Google this and then we're gonna be out of here. Okay, we'll be out of here soon. Who owns Nvidia stock? Who is the CEO of Nvidia? Yeah, so that's him. Ginseng Huan. He's the CEO. He's buying more shares. He probably giving the shares out to people in his company. But why would he buy all these shares if he thought the company was going to do bad? So that's him. He's buying all these shares. So you can see this address right here is the same address, 270, 2788 St. Thomas Expressway. That's where NVIDIA is. So that's it for the tricks. If y'all got any information, any questions, y'all can ask me in the chat. Also, you want to donate to the channel, and also if you want to if you want to get more of this, then I have a community. So I'm gonna put my community into the description box below. If you want to join my community, it's about $30 a month to join and get this knowledge right here. And if you want to join my options community, it's about $99 a month. Well, I teach stock options. So all these are very valuable. Again, I'm not a, if you're looking for a flashy person, that's not me. I'm just here to help you all out and teach you the stock market the right way. So that's it for this. And I'm going to say peace.